One of the most important concepts that we're going to cover this semester and that is inherent in finance is that the expected return or the expected interest rate associated with a given investment or asset. So basically, expected return, it's related to risk. There's an expected return risk relationship. And in particular, riskier cash flows, greater risk, are associated with higher expected returns, higher expected rates. So what we're getting at is we don't like risk. And in order to be enticed to take on more risk, we need a greater expected return, a greater reward. And this is a concept that we're going to talk about now very basically. And by the end of the class, we'll have created a very rich understanding and models that relate to this relationship between risk and expected return. Less risky cash flows, you don't need as high a relation as much of a reward, so you're willing to accept lower expected returns and interest rates. If I told you I have an investment, it's very, very safe, investors would be willing to hold it and not need a big return. So there's a relationship between risk and expected return, risk and reward. In this class, when we relate risk to expected return or expected interest rates, the risk that we're talking about is the risk that matters. And that's a concept later in the course in risk and return that we'll talk about, but it's important that when we look at risk and return, risk and expected return, that we are being consistent. We're going to impose a simplifying assumption in Finance 301, a flat yield curve. Not going to really get into what that exactly means, but what it means, one of the implications of it is that the rate, the expected return, expected interest rate associated with any set of cash flows, it depends only on risk. Sometimes, if you don't have a flat yield curve, you could have different rates that have the same level of risk if the cash flow timing is different. By opposing a flat yield curve, the timing doesn't matter. So if we have two investments that have the same level of risk, then they're going to have the same expected return, which is what I'm going to get to in a minute. It doesn't matter if one of them pays investors in a month from now and the other one pays investors in 100 years from now. The monthly rate on those would be identical because they have the same risk. Based on this assumption of the flat yield curve, we can make that. And the reason we do that is to simplify the world and to really drive home the fact that we can look at risk through expected return. In well-functioning markets, one of the important implications is that investments in assets with the same amount of risk, the same level of risk, will have the same expected return. And the reason for that is simple. Suppose I had two assets. They had the same level of risk, but one had more expected return than the other. Well, everybody would want the one with the higher expected return. Nobody would want the one with the lower expected return. Therefore, there wouldn't be an equilibrium. The only way there could be an equilibrium is for folks to be indifferent, in which case assets with the same level of risk have the same expected return. And this is an important implication of a flat yield curve. In this class, we're going to assume that all markets for financial investments, so when we talk about stocks and bonds and investments and things like that, we're going to assume they're well functioning, which means we can focus on expected return that'll tell us something about risk. Also, when we look at markets for assets like buildings, plant, stores, things like that, when we have questions which one is riskier and things like that, we can focus on the expected return, or as we'll learn later, it's called the cost of capital. We can focus on that rate and assume markets are well functioning. So again, this assumption of well functioning markets allows us to simplify the world and to focus on risk by comparing expected returns.